Starting for quite a while ago, when the 10-year was at 270, 280, I was looking for a 2-year target, which seemed outlandish, but we are there and we have gone past it. My next expectation is that it's going to go all the way down to 150 is my next point. I think it comes from 3 different factors. First, despite all of the central bank stimulus that we have seen this week, we are not going to see inflation pick up anytime soon. That is going to push the bond yields down. After 10 years of economic recovery, I see the global economic growth slowing, as well as in the United States in particular. That pushes the yield down. And third, the global uncertainties, such as the Iran situation now, and possibly including what happens with the South China Sea, where the US and China have taken antagonistic positions, that is also going to come up sometime between now and next year's elections. All of those are going to making me very bullish on US Treasuries, even at a 199, 198 yield.
All right, David, why don't you leap in here? If bonds perform as Sri suggests, or even if they perform a little bit as Sri suggests, there's not much then competition for stocks. Is that an argument, all other things being equal, to put money in stocks, or if you've got money in stocks, to keep it there?
Well, I think the thing that I'm looking at is that the rates have come down on the long end. They haven't come down on the short end. And I think the market will do better as the short end comes down and the yield curve steepens out a bit, because that will take pressure off the liquidity in the financial system. So I'm generally bullish on equities. Everybody's afraid of a new high. So am I, but I've been here before, been doing it for many years. I've seen many new highs, because when I got into the business, the Dow was, I think, 1,000. So it's not like it's the first new high. Rates on the long end have been this low before. That's not the problem. The problem is the short end is too high. And as that comes down, stocks will go up. So I think there isn't necessarily a correlation, rates lower, stocks higher, but the Fed is determined to keep the economy going. That's going to allow companies to continue to earn money, buy back stock, and pay dividends. So I think we're fine.
Shri, on the way to a 1.5% yield on the 10-year, do you see an inversion of the yield curve?
I see the inversion of the yield curve. Melissa, you have already seen that happen with the 3-month to 10-year. I think you will see that happen with respect to the 2 to 10, as well as the 10-year goes to 150. Before that, I think you will see the inversion of the 2 to 10 as well. That's one point. Second is, compared with what David said, I think you're going to see a significant drop in the short yield, and it is not going to support the equity market. And the reason for that is that you have the headwind that is coming from several factors. The Fed doesn't have the credibility it may have had 10 years ago after missing out on its targets. And you're having a situation where the inflation just does not pick up. And under those circumstances, it is very difficult to justify equities, even with Fed backstop, when that is the only backstop there is.
Why don't you answer Sri there, David, and his particular point about how rates are not necessarily a favorable wind for stocks, but also address the question about financials. If I own them, if I'm eyeing them, are they a good place to put money? And if so, which ones and why?
Well, I think the financial sector is, we've seen what's happened in Europe, what's happened in Japan. The stocks there trade, especially in Japan, trade about half the valuation as they do here in the U.S., primarily because the spreads have gotten lower. And that's a big risk in the system, and that's something that I'm watching the most of. All the big downturns in the market since I've been doing it have been generated by a financial problem, not something at Microsoft or Intel or Facebook or something like that. So that's what I'm worried about, and I think that's why I think the short end coming down will allow the Fed, the companies to cut their deposit costs and give them a little margin. But I think there's 2 things happening here. One, there's tremendous rate pressure because the Fed's not going to, I think the rate rise is over and we're going to see a rate decline here from here. Secondly, is the tech companies from various different angles are coming after these companies. So I'm focusing on the biggest banks out there that have the profitability to invest in technology, and then the fintech companies themselves, like Visa, MasterCard, PayPal,
Right.
and something like that. So those are the names I own. The smaller you get, the more you have to worry about or plan on consolidation and cost cutting and things like that to drive earnings. And it's going to be much more difficult with low rates.